There's no information out there that nobody knows. Everybody knows something. There's always somebody who knows something that somebody doesn't know. So when I share something, if you think that is useful to you, then it will be good, to share it. It will be good to share because it might help. Maybe only one person. The one person that it might help may also help him to help someone else. So that's the reason why I think it's better to share. So if we are live,
all right, so we're live on Facebook.
Okay, introduce.
All right. Okay. Good afternoon, everyone. My name is Taye Asere. I'll be hosting tonight's meeting. Co-hosting with me is Rosalind Chua and Caroline Olok. Today, we're so excited to be bringing part 2 of our tax planning webinar. And we want to say thank you so much to Russell Folders for hosting the first class. And now we're doing part 2 of it because just from part 1, we noticed that we have so much more questions to ask. And I know we're all prepared tonight to listen, as well as to ask those questions that arose from part 1 of this webinar. Right now, I'd like to go over to Rosalind Chua. I'm sure she has some few words for us as well as we invite Russell to speak to us tonight.
I think she's mute.
Yeah, I think that's taken care of now. Hi, everyone. I'm super excited that Russell decided to do a part 2 of this. I gained so much knowledge the last time, and I can't wait for everyone to gain as much knowledge as we did. And he's super helpful too when it comes to asking question and answering it. So I'm so excited, and I urge everyone to get your notepads out and start taking notes. This is massive information that you need to actually take your business to the next level. I can't wait to listen to him, and I'm pretty sure everyone's super excited. So hope to hear from you all. And back to you, Ty. I'm super pumped to be here.
All right, thank you, Rosalind. So Russell will hand the class over to you. We're ready to learn, and we have our pen and papers all ready. And of course, we have a lot of questions too. So
Okay, thank you, Taye, and thank you everyone for being here again for this part 2 of this tax planning session. So basically, the first session, the first part of it was to globally introduce you guys to what is tax planning, whether it's on the business side or on the individual side. We laid out the foundation of tax planning, which is the first thing every citizen, every taxpayer needs to know, or every business owner or entrepreneur in general. Today, I want to get a little bit into some detail because we gave you a whole picture. Now, I mean, of course, even though we take 10 hours, we will not be able to disclose everything. That's the reason why today I want to take one angle, which will be by experience, the 3 months or the 3 common mistakes that entrepreneurs and even business owner, I mean business owner with employees still commit or still makes, and that costs them thousands. I'm not talking about thousand. I said thousand with S. That means it could be $20,000, $50,000 in taxes, right? So yeah, I thought that it would be really helpful for me to share this with you. Of course, during the development, you're going to know why is it that each of these elements that we are going to disclose it prevents you from receiving more refund or from paying less taxes. So that is what we're going. Oh, I think I forgot to share my screen. Let me go ahead and do it right now. Okay, I hope everybody can see my screen now. Yeah, I was talking to myself right a few seconds ago. So yeah, basically we're going to go through the 3 common mistakes that self-employer, business owner, entrepreneur in general makes. and that prevents them from taking the full advantage of what is actually being saving in taxes. So of course, what are we going to cover? We're also going to cover the state of PPP and EIDL. I'm going to share with you the new onboarding system that we have developed to help taxpayers. And we are going to have a Q&A to actually answer all the questions, okay, that you guys may have, whether from the previous session or from the actual session here. So yeah, so like I was saying, during this webinar, I'm going to share a lot of things, and I'm going to also give you the answer on what you can do to avoid those mistakes. I'm going to share with you some example of the situation where, because this person didn't do that, he was fined, or he almost got fined of this or that because of this simple mistake that business owner actually overlook, or we don't even see the importance of it. That's why we call mistake, because they don't see it. It's like in front of their eyes, but they overlook. They don't think that it's causing them something. Okay. So if everybody is ready, I'm going to take you to the board, because we are actually going to be able to see everything on the whiteboard where I'm actually explaining and trying and writing some example and some notes that you can actually take yourself. So if everybody is ready, I'm going to take you to my presentation right now. Hey, hi guys. This is Russell for us. We are here today to talk about this important topic that I introduced since yesterday for business owner and self-employed people. So, if you're new to this channel, my name is Russell. I'm an payroll agent, and I'm specialized in accounting and tax strategy for small businesses. So recently, I've been dedicating myself and my team on helping a lot of business owners, to get this PPP money, and also the AID that is still going on, by the way. So the reason we have this meeting today, normally this is a weekly meeting that we have in the Facebook group. But today I'm giving the opportunity for other people to share this important topic that concerns business owner and the expenses. Basically, business owner and the saving in taxes every year, because nobody wants to, always be paying money for free to the government. The government will also be happy when they get the money, but they will never say thank you. So if there's a way for you to pay that money, the less amount possible, it will be a good thing. That's the reason why I came up with this topic, which is the three common mistakes self-employed people and small businesses make every year, and that costs them thousands and thousands in tax bill, basically. Okay, so if you guys are ready, let's go. Most of the time, those three common mistakes who seems like normal thing, and some people may think that, okay, what are those mistakes? Those mistakes are so common and so obvious that when we talk about it, some people feel shocked, but most of them still are unable to take action. And the goal I have here is to have you guys start thinking differently when it comes to those type of mistakes. You can avoid those mistakes by not spending money, just by having a new way to conduct your business. That's the point I want to share with you here. So basically, what you have to do is to listen. At the end of it, you have to think about, go around what we are going to explain now. You can do it by yourself, but in case you cannot do it, your accountant or your tax professional will actually help you to do that. That's the point That's the point I want to make here. That once you learn about those mistakes, you have to actually think about if you can find yourself among those three mistakes. If you don't find yourself, congratulations, because not all business owners, self-employed, individual people are not organized. It's just a matter of organization and seriousness about what you are doing. Okay? So basically, we're going to jump right away into those topics. The first one will be what? The first mistake that, 80% of people that are hurt, because most of the time when I come with the webinar or video live, is because when I'm consulting with this small business owner to help them with their taxes. That's what I noticed. And sometimes that is how I come up with the idea of running some type of live webinar. So that not only you will address the issue for them, but you can also address the same issue for other business owners who may have the same type of problem. So very quick, what are the three common mistakes? The three common mistakes. Of course, there might be hundreds of them, but the three that are more often observed, common mistake that people do to make. The first one, what are the three common mistakes? The first one is no record keeping. The first one is no record keeping of your activity. That's the first common mistake that many business owners make. The first one is no record keeping. I have helped over 700 business owners now to get the PPP and EITF and money. Among them, not even 85%, not even 15% of them were keeping the transaction, were doing book record keeping of the activity. Okay? And it cost them money. It cost them a lot of money. Why? Because the first thing is the risk. When you are running a business, you have to avoid any type of risk that you can avoid. The first thing is the risk of an IRS fine. That's the first thing. You don't even see it. The first thing is that you are in the risk of being fined by the IRS in terms of audit. When you are running a business, okay, over here I'm talking about people who have an incorporated business, an LLC, C Corp, S Corp. When you look at your article of incorporation or maybe the operating agreement of your company, if you read it, most people don't even read it. If you read it, the bookkeeping system, the record keeping of your activity is a requirement by the law. That means you are exposing yourself to a possible fine. I remember last time, 3 years ago, there were this eye doctor office. They were fined almost $50,000 because during the audit, they didn't have no record keeping. They have to come up to us to actually create a record, create a bookkeeping for 1 year, and actually show that they don't even have, actually they didn't have to pay taxes, but the government wanted to see that, yes, your tax that you should pay is only maybe $50. But they want to see how you can show them that your tax is only $50. So they have to spend around $10,000 with us for us to, in 2 weeks, create the whole bookkeeping, create the organization structure, everything into a bookkeeping system, and show them to show the government, because they have features when they come to, they give you 1 or 2 weeks to come back with the response. So they have to do that. Otherwise, they will be fined $50,000 for that. So that's the first thing. But it looks like, it doesn't seem like being scared, smart, a lot of business owners. But what is very important that business owners are really losing, is the loss of deduction that you don't remember. Okay? The loss of deduction that you don't remember when you don't keep your bookkeeping, you don't keep your financial transaction. And mostly expenses. Last week, I think it was 15 minutes webinar where I was talking about the consequences
of losing money or how to save money by keeping your book. So if you want to get the full detail of what I'm talking about, go back and watch that live, was 15 minute live, where I was explaining how not keeping your book makes you losing money. It prevents you from saving money, basically. Because listen, I have somebody here who came to me and said, okay, what are your expenses for the year during the taxes? They come up with I don't know, most obvious expenses, but there are so many other expenses that you will not even remember if you don't write them down. That's the point. If you have a business, any type of business, whether it's an incorporated business or it's a self-employment business, that means a business that you are operating without actually, the need of incorporating, of creating an LLC, for example, because a business is any time that you do that generate money. The business is not always when you have an incorporation. Most people will get confused at this point. When you are a business owner, it doesn't mean that you have an C corp, S corp, LLC. As long as you are operating an activity that generates the money, and then you know that will bring the money you want to pay to the government, you have to take it seriously. So basically, what happens is that anytime that you have a business, you have to keep track of all your expenses. Over here, I'm not even talking about the income. The income will be the next section of this webinar. So over here, when you don't keep your expenses, what will happen is that there are so. Let's say you travel to New York during the trip, you have to stop at the restaurant. You eat. You go there for business purpose. At the time you remember, when you come back, you have the receipt. You have the train receipt. You have everything. But over time, after 1 or 2 months, we don't even remember what the receipt is. Or if you know what the receipt is, we don't remember exactly what came into it because you have only one receipt, and you spend a lot of money along the way. Every day you are fixing your car, you are repairing your car. If you don't record every day how much you are spending on your car, if you don't record every day how much you are spending on the oil change, if you don't record every day how much you are spending on the food that you are consuming in your job place, chances are that you will never remember for sure the amount of food that you spend on during the year. And those are what are called loss of deduction that you don't remember. Because as a business owner, at the end of the year, you are entitled to deduct expenses on the gross income that you make. Only when you deduct expenses that will come out, that will stay with the net income, basically. That net income will now allow you to actually know how much you will be charged for taxes, basically. So what I'm sharing here is that whenever you don't record your transaction, chances are that you are overpaying in taxes because you are losing a lot of opportunity of claiming expenses. Okay, the supplies, you are purchasing supplies every day. The people who has the beauty salon, they purchase hair, they purchase a lot of stuff. Now we are using sanitizer. Every day people have to order new hand sanitizer. Everything to make the workplace clean and COVID-free area. So if you don't think that you have to record your transaction, you are losing a lot more money than you think you are saving. Okay, most people don't. The big thing, you know what the big thing is that your rents. If you don't record your rents, I have people here who, when I look at the schedule C, I look at the schedule C as maybe, let's say, $40,000 as a cost schedule C. Out of the $40,000 cost, that's what they're claiming. And it's taking it to the next point. There's no way you can even claim your rents because you have a workplace, you have a repair shop, you have a supermarket, you have this. You are claiming $40,000 as a tax, as a cost. How are you going to claim your maintenance, the maintenance of your car? How are you going to claim your rent? If you pay only $1,500, monthly, 1,500 monthly. At the end of the year, this is around 18,000. Of course, there's no way you're going to collect 18,000 expense only for one item out of the $40,000 gross income. The 14,000, when you are selling something, if you are selling something, the higher cost will be how much you purchase, it will be your raw material and the cost of purchasing the thing that you are selling. So basically, this takes me to the next point. The next point is that people tend to hide income. That's the next mistake that people do, business owners, right? They tend to hide their income or to underreport their income. When you are underreporting your income, what happens? The first thing, and when you have a habit of doing that, the first thing is that you will never know about the real health or the real performance of your business. That's the first thing. You will never know how good is your business. Because you are making sales doesn't mean that you are making your business is profitable. Basically, you are running a business to be profitable, not only to make sales. If you are making sales and you don't record those sales because you're going to underclaim and state your sales. First of all, you have to match those sales with your expenses to know if the business is profitable or not. You don't just have to just making sales and look at your bank account, you see the money, you see the business is good. The level of your bank account is not the result of your company. I mean, the balance of your bank account, it will never be the result of your company, because that's the reason why on the monthly basis, you have to do what is called bank reconciliation. Because in your bank account, you may have $1 million in there as a balance. You may also be missing a lot of payment of supplier that you have not made yet. That means if you have $1 million in your account, and then you still have outstanding invoice from supplier of $900, even your real balance is actually $100, right? So how do you know that? You know that because you have the reconciliation of your bank account, and you only do that if you have your records. If you can record, if you have a trace of all your transactions, and some people even forget about money. Okay, not recording. I have people who forget about money. That means when you are making a lot of sales, some sales that you make, you don't get paid the same way. You get paid over time. That's the reason why we have what is called account receivable, AR. The AR is because when you are selling goods or services, sometimes you can get paid after 1 or 2 weeks, sometimes even a month, depending on the agreement with your customer. So when you are hiding your income, the first thing that you are doing is that you have no clear vision of your own business. You have no clear vision of your own business. Yes, and what you are also losing is that there's no way you are losing in terms of potentiality of funding by bank or by new shareholder. Okay, so if you have a business, you want to expand. Some people are expanding their business right now because of the COVID-19. I've been saying that the COVID-19 will either break you or make you. Some people, the COVID-19 is making them at the point that they are actually expanding their business. So if you want to expand your business, expanding means that you want to create new things, new facilities and stuff. You need most of the time you need funds. You don't always need the funding from your company, right? Most of the company will expand or will get to the next level of their growth with new investment. The investment will be from the bank with a loan or from a new partnership. People will get over to your company and get some percentage of the share of the company. If they want to come to partner with you, you have to tell them. Let's say you are already keeping your record. You keep the record of the transaction. But now you come here and you hide your income. That means you don't even show all your income in your financial statement. Let's say it like that. Do you really think in your income statement, do you partner with think that your business is good? Even though you know that you're making $1 million of sales every day, No one will partner with you. And that is an opportunity that you are losing. That is what we need to know. It's an opportunity that you are losing whenever a bank cannot see you as somebody who can pay back his debt. Let's say you want $100,000 or $200,000 from the bank. You know that you can pay it back. But if the bank is asking for only your income statement, they don't see no income on it. That's no income. There's no way you're going to get those funding. Now, when you don't get funding, you are losing on opportunity. You are losing on money because you are losing the business. Now, on the tax-wise, what happens is that when you are hiding your income, it comes back to what I said earlier. When you are hiding your income, there's no way you can claim all the deductions that you can have. I'll talk about rents. I'll talk about decide rents, what do we have? I'll talk about repair.
Car maintenance. Car maintenance.
Car maintenance, yes. Car maintenance. That means everybody is maintaining the car. Whether it's a new car, you see a brand new car, go back. You have an expense, like sales expense. Today, there's no way you can sell without spending money. There's no way now you can actually make a sale, even though you have the best deal, the best product in the world. There's no way you can sell without incurring new sales expense. You have the marketing is a strategy to make money. Whether you are, it's good because you can reach out to new customers. When you are hiding your income, this person will claim $40,000 as income because in their mind, oh, I don't want to pay more tax. I don't want to pay more taxes. So over here, you are claiming $40,000 because you don't want to pay taxes. Of course, you're gonna come down here to maybe $18,000 taxable income. What you don't know is that if you have record all your transactions, if you have record all your transactions, you have record all your income. The first thing is that you have been able to claim there's always more income, more expense than we think we are making. Just like if you are making $100,000 a year as an individual, let's say $70,000, okay? You are making $70,000 a year. Okay, at the end of the year, you are going to file your taxes. What happened? The fact that you're going to pay maybe $4,000 taxes. You are paying $4,000 when you just say that's tax bill. It's because what was collected was not enough. I mean, the real tax bill is around 22%. What does that mean? It means 22% of $20,000 what? Don't have a calculator here. But it's a lot of money, more than $4,000. That means you have collected a lot of money during the year. Now, what did you do with the $70,000? Because most of the time, when you look at the bank account, people who have the $4,000 or even $1,000 bill, they always ask for payment plan. Why? Because they don't have the money in the bank account. I'm talking about one single person. I mean, you yourself, personal expense. When I ask them, what did you do with the $70,000? Nobody knows. You know what is the bigger expense? The bigger expense that everybody makes, every individual, not even at the business level, every person during the year, the bigger expense, even when you are applying for a line of credit, what do they ask you? They ask you for how much you pay for rent. Remember, I talked about rent earlier. If I want to talk about rent again, you pay $15,000. That's the average rent. 1,500, sorry, times 12. That is around 18,000. So out of the 70%, out of the $70,000, the bigger expense is 18,000. So what did you do with this money? Nobody knows. But if you have to check this his head and his mind and trace every single day for the whole year, you will see that he spent that money, but he doesn't really know where he spent the money, right? Nobody knows. When I ask, what did you do? Did you purchase a new car? No. What happened? What did you do? Sometimes the person is living on the financial aid, maybe he didn't have a lot of student because he was going to school. The income didn't allow him to get eligible for financial aid. So he didn't have a loan on top of that. But he doesn't know what he did with money. What about the company? The company is an entity that spends money every day. Every day, sometimes you don't even know when you spend the money because people are spending money on payroll. You might be spending money on furniture. You might be spending money on electricity. You might be spending on a lot of stuff, on supplies. So you don't really know how much you are spending. So over here, if you have to match your income with your expenses. You may still come with maybe the $18,000, but guess what? You have a better company here that you can even sell. You hear people selling the company, even though you have only 18,000 profit here, but your cost was $700,000. You still have $18,000 profit here. This company is worth it more than this company that is claiming $40,000. The point is not to think about hiding your income. When you hide your income, there are so limitation of what you can actually take as a deduction. And sometimes it's ridiculous. I saw people here coming here on their taxes, and they just claim the gross income, $16,000. I don't want to talk about the people with the name. They claim $16,000 as a gross. What are they going to do? Because they just want to pay taxes on $16,000, they bring the same $16,000 down as a net. Can you imagine? That means he or she, I don't want to say the person, they claim $16,000 as a gross, right? And on the net, they give another $16,000, just like it was a salary. That is crazy. Why? Because you, as a net income, as a business owner, your net income, you are paying $15,000 on what is called self-employment taxes. A lot of people don't know. Self-employment taxes, you are paying $15,000 on it. Self-employment taxes. That means if this $16,000 was for her to pay herself, and it will take me to the last point. This $16,000 year net income that she's going to show as a taxable income for her, she's paying 15%. When I say 15%, it's about Social Security and Medicaid. So Social Security and Medicaid, you as an entity will only pay half of it. But the business owner pays 15%. You pay the whole thing, which is about 15%. That's what I'm saying. She's paying 15% of this $16,000 because she's trying to say, oh, I just want to claim 16,000. What if you want to understand better? If you get the same 16% and you are a tax professional, you plug it as a W-2 income, you will see that your tax refund will be higher. Then the same $16,000 was reported as a Schedule C income, profit or loss of business income. So that's where a lot of people are just getting lost, right? Because first of all, it's so obvious that you are exposing yourself for audit. And I was talking to, I don't know if the person is right now, I was talking to myself like, what you are showing there is a big red flag, right? It's a big red flag because the IRS audit sometimes is a software. The software, just like this EIT, I told you that people are receiving denial right because sometimes the software see your application as crazy, just keep it the denial. That's the reason why in the Facebook group, I show everybody how to come back and apply for reconsideration. All right? We're going to discuss about that maybe at the end of this meeting. So over here, I told the person, the number I see here, first of all, is preventing you from being eligible for what you're supposed to get because the DITF money, remember, those who are the money, the higher your gross, the higher your eligibility. So the person was losing in terms of eligibility because the claim is income. I don't think it was intent, he said that, or the person did not just did it for him. So I told him that it's a big red flag. As we talking, and he told me that yes, I actually received the letter from the Maryland state. The person actually in Maryland. So I'm like, you see, I don't even know you. I mean, I don't know. I didn't know whether you want me to be there or what. When it starts with the Maryland, the State Department, Tax Department, the Maryland will actually send it to the federal. They will audit you. When they audit you, most of the time they will go back. They will know that that is the same thing you are doing over and over. Sometimes they will go back 1 or 2 years, depending on how quick you are responding, right? So the point is that when you are hiding your income here, you are limiting yourself in how much you can claim. I just told you that somebody making $70,000 a year. At the end of the year, you have nothing in his bank account. Almost nothing. But if you didn't make a big expense, I don't want to go into what he has lost in terms of tax planning. I don't want to go into that because out of this $70,000, he could have still spent the whole money, but get this money being brought down to maybe 50%. That means if they had consult a tax professional, the tax professional should go up. I'm talking about an individual person who have told him what are the bigger expenses that he's making, and what helped him to make this $20,000 becoming $50,000. That is $20,000 taxable income. Say, if you want to take 20% of $50,000, you know how much money it is. So yes, that is the point I want to make here. So the last point I want to make is that when you don't, the third mistake that people do is that they don't account for, they don't account for their own compensation. So they don't account for their own compensation. Remember over here, when you claim $40,000 a year, you can even claim your whole rent. What about your own compensation, owner compensation of your business? So a lot of business owner, I'm talking here sometimes even bigger companies that are owned by partners, they don't even account for owner compensation. Owner compensation could be a guarantee payment, it could be a draw, it could be a payroll, right? The obvious one that gives you a very clear possibility of claiming it in your taxes is what? It's a payroll. It's a payroll. It's a payroll, right? I just told you that when you don't claim all of this, you are losing. You are losing on rent, on repair, on sales tax. I didn't even put down here what I just put here, your own compensation. I didn't even talk about your own compensation right here. If you are a business owner, you should pay yourself. The result of your business is not your payment. No, it's the return on investment. If you have a company that is spending millions of dollars, at the end you see the net income is around $500,000. $500,000 is not your salary, it's the return on investment. You should have accounted for your own compensation before you get to the $500,000 profit. Because it could happen that it doesn't belong to yourself. It could happen that you really sell the whole company. Some people create a company and then they sell the company. They're still in the company. And they're still making a lot of money because they have a salary, they have a payment in the company. So the profit is just the return on investment of the money that they put in the business. So if you don't get, you don't actually record your income. You don't record your transaction. You don't hide your income, and you hide your income because you don't want to pay a lot of taxes. The most thing that a lot of business owners out there are doing is that they don't account for the owner compensation. I'm going to take a really simple scenario here for you guys to understand. If you are working on your business, let's say you pay yourself, you don't want to charge yourself too much. You pay yourself 18, let's say $20. You pay yourself $20 per hour, right? If you have to come in for by 4, that is how much? 8. That is $800 every week. That you should be paying yourself every week. If you have to time it by 52, how much is it? You have 4160. That is $41,060 that you're losing in your business. Me, I work $150 per hour. That's why I get paid for my consulting, $150 per hour. So I don't know if I have to, on my paycheck, of course, maybe I'm not going to do $150 per hour, even though I charge those people. Of course, what I'm charging them is not my salary. That is the cost of selling a service in my company. My company now can hire me for maybe $50 per hour, right? Because I'm working for my company, even though when I'm charging people, it's not my salary. It's the cost, it's the sales of the business. Because out of the 150, maybe the 50% for my own salary, maybe 100% is for the rent, and it's for the cost of renting, it's not cost of the equipment, the cost of whatever other cost that the business can do, right? So, me, if I have to work, of course, if someone has to hire me, it's not going to be $50 per hour. It's going to be around this thing. If you want to have it for your company. Now, I'm bringing everything down to $20 per hour. So any job you make, if you have your own company, you're not going to pay yourself $12. Why would you pay yourself $12 for the company within your company? You can't, right? So if you are so generous that you pay yourself $20 per hour, $20 per hour here, that is $41,060. So somebody here who has a very beauty supply shop, a very hair salon, that is actually employing 4 people. That means she has 4 employees, but you are claiming $40,000 per hour per year. Not only you didn't account for all the payment that you paid to the people working for you. You don't really because you don't know how much you want, because whenever I ask people, how much did you pay? Because the employer are not on the payroll. If you don't record your transaction, how are you going to put people on the payroll? You don't want to put them. That means you just pay them every week. There's no way you're going to claim those money. I'm talking about spending $500,000 to people. $500,000. I have people who pay $500 to the people working for them. $500. So imagine that you are spending $500 every week on one person only helping you in your business. Whether it's a repair shop, it's a supermarket, it doesn't matter the business. $500 you spend it on somebody every week. Times 52. No, times 12 first. How much is that? That is times 4 hours. No, don't say times 4. Let's say times 4 because that is only weekly. Okay, this is weekly. We make it 52. Right? Because 1 year has 52 weeks. So 500 times 52 weeks. How much money is that? That's a lot of money. I'm trying to look for the calculator. 52 times 500. That's $26,000. $26,000. That means it doesn't matter how much you claim on your net profit. You should have had a lower taxable income if you have claimed this $26,000 on it. Now, how to claim it? If you don't record your thing, if you don't even put them on the payroll, okay, you're losing them. Now I'm talking about yourself. You are working on the business. right? You work on the business. You are spending, you are losing for $1,000, for $1,600 on business, on your own compensation. You don't take it. What do you think you are losing? You are losing. This is what you are losing, right? You are losing because you are paying income. You are paying taxes on this money. You are paying taxes on this. Whenever you don't claim an expense, it means you are paying taxes on that money. If you are at 22% tax bracket, because when your income is between 39, I think it's 39 to 34, 39,000 to 34,000 to 84,000, you are on the 42% tax bracket. If you are, this is what you are losing, what you are paying basically. 42% of this is around 9,000. So this is $9,000 here that you are losing. Losing means what? It means that you want to keep it for you, or it will be a refund for you. This is what it means. Because you don't pay doesn't mean that you're not losing it. You're losing it because you are not taking the opportunity to actually claim it for you. Okay? Whatever they say you're losing in taxes, it means that not only you are paying more than you should have paid, or you are receiving less than you should have received. That's what they say losing in taxes. So over here only you're losing $9,000. Over here, now we call it the thing. There are so many other expenses that you are taking. Now you are taking your chance to be on the risk, because all the information that you claim on your taxes, there's no way you can even prove. That's a big issue. There's no way you can prove. And if you don't prove it, simply you cannot prove nothing. There's no way you can also leave your financial statement blank without expenses on it. That's the reason why some people will just think about how much they want to claim in taxes. They just go and slam an amount of money inside, right? And they keep the money, or they just deduct a few expenses, they get something down. You are losing more than you think you are saving. This is the point I want to make here. And I've been spending more time than I was actually anticipating. So there's too much into it that we cannot even explain into a single webinar. So I'm going to stop here. If somebody has a question, you can ask before I move or conclude this. Do you have a question? You can unmute yourself. If you have a question. Okay. If nobody has a question, what I'm going to do here is that I'm going to beg you, if possible, to actually start taking the new step if you are a business owner, right? If you are a business owner, start reverse engineering on what you are doing if you really want to save money in taxes. And now you have to think about know how to rate your information, the information in your taxes. That is really important thing, because I have people here who have their income, who have the 1099. The 1099, sometimes they claim one, they keep the other one. You take your taxes, you don't really know. That means you are actually receiving more money than you should have received, because there's a missing of income in your taxes. Okay, when it's like that, it's a big risk of red flag, because any 1099 that you receive, the IRS has a copy, because whoever company issued it to you, the IRS has the same copy as an income, and they are expecting you to actually claim it in your taxes. I have a lot of people. Somebody has $40,000 on one 1099, $30,000 in the other 1099. Now the person came here on this situation, they didn't hide it. But they took 11099 here, they put it on the W2 income. And they put this one on the Schedule C. They put this on the W2 income. And they put this on the Schedule C. The point here where the person is losing, when they put the 1099 on the Schedule C, is that you are hopefully paying taxes on it. It's better that you are on the Schedule C on the payroll because your company, you pay yourself payroll and you shift the business money into your payroll money. It's not a 1099 given to you by an external company, because when it's like that, you are losing. There's no way you can claim expenses against this. This is a W2. It's just like your job different at the end of the year. You have to reduce the car repair, you repair your house, all these expenses. You can't take that. Your W2, the government gives you the what is called standard deduction, right? To reduce your W2, but you cannot claim all the things to make it a loss. This $40,000 could become a loss. Then you can actually come up with $45,000 expense. And this $40,000 will become only negative $5,000. And the negative $5,000 will actually go back and reduce whatever other source of income you have. And that's how you win it, right? So I told him, did you even read your taxes? What did you get? I didn't want to know when. How do you record it on the wage? They call it gross wage on your taxes. The line one, gross wages. They put the 30,000 on it. So that's how it was losing. It was losing on the opportunity of claiming more expenses here, right? So it's for you to think about understanding about your taxes. I'm a tax professional. I don't do taxes to make it magic to people. I always try to have people understanding what is happening in their taxes. It helps me in my job because it it's easier for them to understand the tax situation. It's easy for me to give them the outcome. But the outcome could be that you will see the reform. It could also be that you are paying money. If you understand your taxes, the content of your taxes, then it's easier for me to convince you that you owe $7,000 to the government. But a lot of tax professionals, they are losing on this because they don't want you to understand. Now it's hard for them to tell that you have to pay the government $4,000. Then you will think that you're not a good tax professional because they just telling me just go and do that before you owe this money. They say, why? Because they collect enough money. No, that's not the reason. You have to go into the details of your taxes. Now, over here, what I wanted to let you know is that over here, you are losing. Unless you are not incorporated. That means if you are just a self-employed, that means you don't have your business incorporated, then you cannot do this. It will be difficult for you to do this because the IRS doesn't even know you. The state doesn't know you. How are you going to say, okay, I'm paying myself? You're not even a company. You just can't do that. That's the thing. If you want to take this, you have to incorporate your business, make it an LLC to make it secure. That means it's protecting your own personal asset. The LLC is a company, it's a company structure that protects the owner of the business. If the business has a problem, the business owes money from somebody, right? You cannot touch them. I have one of my cars that was hit by someone, and the car belongs to an LLC. If that LLC is out of business, you're not going to, if it's not out of business and they don't have money to pay you, you cannot go and have the owner or the LLC say, okay, my car, you pay my business because $100,000 they're not paying. You know what I'm doing? If they say, this is all what my business have, I can only afford this, then there is no way they can get to your personal belonging. So you have to incorporate your business. It doesn't cost a lot of money. It doesn't cost a lot, it doesn't take time to incorporate your business. If you are making money, you want to actually account for your own payment on the business you are doing. Incorporate your business, it takes you 24 hours to get all the paper. Then you can take this if you are already in the business, when you are, providing service, you have a business incorporated, whether it's an escort, C corp, an LLC, you are better off. Let me admit these two people in the one now, even though it's the end. You are actually losing money. So if you never account for your own compensation, tell yourself that you are losing $9,000 every year. As simple as that. Because it doesn't matter what you are claiming on your SKBC, you are losing around. And if you're supposed to say, okay, I think on my business, I need to pay myself $22 per hour. Then this goes up. Just as simple as that. When I say goes up, it means that if you have done this, you normally receive 3,000 refund. You should have received 3,000 plus 9,000. How much are you willing to pay for this? You don't even pay nobody to do that. You're not paying nobody to do that. You just put yourself on the payroll. You know this. This could be a tax strategy because when we consult on tax strategy, we can actually see everything and tell you how we're going to do it, how much generally you're going to save. It could be a tax strategy. But I'm giving to you now. The only thing you have to do is to put yourself on the payroll, put your wife on the payroll, put your children on the payroll. Very few business owners know that. Put all your family on the payroll and cut all your expenses. So I'm going to stop here because I didn't plan to go that far. Okay? If somebody has a question about how to yes.
Yes, if you are saying that to put your wife on the payroll, what about if your wife already has a job? So what should you do?
You know, if they have 3 or 5 jobs, right? You yourself. Why can your wife have 2 jobs? As long as you claim your wife on the payroll, you claim an activity that your wife is doing. Let's say you say your wife helped you to receive phone call. That's it. How much can you pay somebody to receive phone call for you? Google, how much can I pay someone to receive the phone call? It's around $12 per hour. That you can claim. Right? Mm-hmm. Yes. I'm not saying to say that you pay your wife $50 per hour for doing nothing. No. You have to think about something. Okay, let's say she's the one, you are shipping stuff, she's the one carrying the stuff, you are doing Amazon business. When you receive your supply, you have to pay somebody to go get them and go drop it to the UPS warehouse. You have to pay somebody to do that. Let's say you're paying your child. So my point was that those are mistakes that you are making. You are making that you will never save money by making those mistakes. Okay? So yes, if you are really serious about it, you are serious about it, and start doing the opposite of what you're doing. Do the research. Record your transaction. This is the first thing. The first strategy on tax saving is to record your transaction because every strategy wants to tell you, if you don't record it, you cannot claim it. It's to record it. Now, do not hide your income. You don't hide your income. Your income doesn't help you that much.
Excuse me.
Yes.
Yeah, when you say recording your transaction, to prove that you have to have the receipt, right? Or we just have to, if you spend money to do something, you just have to write it down, or you need to have a receipt to prove that in case the IRS maybe ask you for proof.
First of all, yes. You have to work if the transaction happens. I'm saying that when I say record, I'm not asking you to go there and sit down and start writing stuff in the paper, right? If the transaction happens, write it down. Now figure out how to prove it. How to prove it is what? It's the receipt. It's the best statement. If you use your bank, you first of all write it down because they will never ask you to show all the receipt. That's the point. But they want to see if it's written down somewhere. You see the point? They will never say, even on the audit, when you show all your bank statement, you have $100,000 transaction. Nobody will ask you to show the proof of all the 100,000 transactions. No. Then I pick 1 or 2 of them. Can you show me the receipt of this trip that you made to Ohio? What did you go there for? Of course, you have the receipt. Now, what in your accounting system, you can actually even create your own receipt in an accounting system because you really spend the money if you don't have the receipt. You can create it because you still remember if your booking system, basically. Right?
Okay. Okay.
Yeah. So I don't know if you have more questions.
Okay, thank you guys. Thank you guys. I hope it wasn't too long. And I hope you got something out of it. Yes, my point is that you guys are making 3 major mistakes out there. Okay, so I'm going to start taking you guys' question now. Those were the questions from my audience when I was doing that. Now I need your own question and tell me what you have been doing, tell me what you have been failing to do, and tell me how you think you're going to do otherwise. So what's the first question? Ty, I'm talking to you first.
Oh my God, thank you so much, Russell. That was really impactful. I see that we're making a lot of mistakes in our business. Well, as a small business owner, it's always very difficult to keep records. But I appreciate last time, the part 1 of this class, you had shared with us an Excel spreadsheet where we could save our records. So in addition to that, today, we learned that we also have to keep receipts. And if we do not have the physical receipts with us, we can always regenerate one just to keep track of everything that we're doing. So thank you so much. The first question that I have is, as business owners, when we work, we pay Social Security. Social Security is deducted from it. We probably have health insurance for our employers. But now that we're now business owners or we're starting our businesses, how do we pay Social Security so that we have some type of retirement plan? So if you can please answer that question for us.
So that was the first question.
Yes.
Can somebody mute themselves? Okay, thank you so much for that question. That was an interesting question because anytime I consult with people, I show them a mistake, they're like, okay, now how can I do that? I have a lot of self-employed asking me, how can I prepare for my retirement? How can I do the 401k? Can I still do 401k? Because when I'm working, the company is matching the 401k for me. I contribute 50%. The company contributes the other 50% for me. So how do I do now for my retirement? That's a very good question. The simple answer is that even as a self-employed person, you can still register your account as a 401k, okay, as a simple entrepreneur. But it's really costly to do that if you are a self-employed, to do the 401k, because as an employee, your boss is paying something for you. Okay, now that is yourself. You're going to pay for the employee, you're also going to pay for yourself. The solution I have here, which is actually another tax strategy that we will actually go through for an entire webinar, is the type of retirement you can take. Basically, we have one of them that is called SEP IRA. The SEP IRA is actually one of the easiest employment or retirement account that a company or business owner can actually take, because it doesn't cost that much to maintain, because sometimes those things is the cost of maintaining those accounts, those retirement accounts. So the SEP IRA is actually the solution that actually advice to business owner. Yes, you can still have your own retirement account. Now, if you have a business, you can actually pay yourself. I just told you can pay yourself salary. You can also pay yourself all of those compensation as a business owner. That means your company, actually it becomes an expense to your business. Listen, your business is making money. You cut some money to pay yourself. You take that deduction at the business level. Remember, it's your own company. That means the company is paying less taxes because you are paying an employee, which is still you. Now, at the personal level, you are actually now receiving money into that account. That is actually tax-free at the individual level. So yes, there's a form of actually if you're self-employed, yes, when you pay for that, it becomes a business deduction. And at your personal level, it becomes a tax deferment because it's an income to you. but you don't even pay taxes on it. Yes.
Thank you so much, Russell, for answering that question. Because I know that for entrepreneurs or business owners, especially small business owners, one of the biggest worry is how do I have a retirement fund going for myself or the employees that we're bringing into the business. So so we've heard today we need to get our self IRA started, and also that is also a business deduction.
Yes.
It's a win-win for us. All right. So I want to ask that if we have any questions, we can either type it up in the chat box, or if you indicate by raising your hand using the emoji, so that we can start taking questions. So I see that Rosemary has already unmuted herself. So Rosemary, you can go ahead.
I thought I was already speaking. I didn't realize that I was on mute. Maybe it's not my turn yet to ask my question, but I wanted to piggyback off what you had asked. So the RA account, can you pay as much as you want into it? Because you're a business owner, you can't decide to say, okay, I'm going to pay like a lump sum into it. Is it something that is obtainable as a business owner?
Okay. Yes. The SEP ROA is that you cannot contribute 1 million into it, but the limit is actually higher than like 90% of any other retirement account. That means that you can put, I think it's like up to $65,000 in 1 year. That's a lot of money you can put in, and it's your own money. You see, you were thinking about how to save money for my retirement, right? Now they'll give you the home with a normal IRA, whether it's a home or normal traditional IRA. I think it's a 5,000 a year that you can contribute. But over here, the limit is so higher. That means you have, and it's like you can change it from 1 year to another year. It's not that you have to, whenever you have, if this year you make a lot of profit, then you can contribute more, maybe 30,000. Next year, you don't make a lot of profit, you contribute only, I don't know, 5,000. Okay, so you have that flexibility. Yeah, I have, if you want to schedule it, I have a webinar, a whole session where we can go through it, okay, to explain to you how you can take tax advantage at the business level and on the individual level when it comes to SEP ROA. Yes, you have the flexibility to contribute more than maybe other retirement account. Yeah.
All right. Good point. Maybe one more question before you go to the other people, Ty. So I know that during your webinar, somebody had asked, so how do you report an extra income? Say you hire your wife or your other spouse, your significant other. I know that when people have 2-3 jobs, it does affect them when they file taxes. So how does that even, like, if you can explain, how do you claim that more money so that it doesn't affect your overall income or it doesn't affect you when you file taxes?
Okay. The first thing is that when you are hiring family members, depending the child, the direct family member, your wife or your children, the first thing you are saving over there is what is called payout tax. When you hire somebody, you pay payout tax, Social Security, unemployment, and stuff like that. Imagine that you are hiring your wife and then you don't have to pay that Social Security. The main point here is that the money you are giving to your wife is actually deducted from your company. You're actually giving the same money to yourself. Okay? You're giving the same money to yourself. It's going to increase a little bit of that amount. If it's 10,000, yes, it's going to increase 10,000 to what money your wife received from the other source of income, right? But 10,000 is what? 10,000 is if it's 10% of taxes for your wife, of income tax, because let's say your wife already made income and then you add her $10,000. Your wife will be paying taxes on basically 10,000 more. If it's 10%, that's $1,000. But how much are you saving? You are saving in so many ways because you are saving on the business deduction. and you are saving on the tax level because that $10,000 preventing you. That they call it the way to shift, to change the tax bracket. If the same 10,000 would have been in your tax bracket, you have been paying taxes, maybe you belong to 37 tax bracket. Now you're shifting the 10,000 to your wife. She's only on 15,000 tax bracket. Can you see it? And at the business level, you are taking a deduction. I'm not even counting that if it's your child. Basically, if the income doesn't reach a certain level, your child will pay $0 on that taxes. Okay. And I also have, we can also have a full webinar on it when I'm explaining that you can actually hire your family member to do everything. I talk about, taking stuff to the UPS for Amazon or for people selling physical product. I was talking about just answer the phone call. You can hire your son to just wash your clothes. Like if you are using uniform for your job, hire your son to just wash your clothes. Those, and I can actually share, if you do the webinar, we share the list of at least up to 50 jobs. You can hire your 7-year-old to make a coffee to you. Can you imagine that? So there are a lot that we just miss or overlook until you consult. When you go to the doctor, sometimes you feel good, right? Until the doctor tells you cannot go back home. He's like, why can I go back? I say, no, because you have to take the emergency room. How can you get it? Did you drive to come here? You say, yes, I drove. I can't believe you drove to come here. When I see your high blood pressure, they have to admit you in the emergency room. Yes, until you consult, you will never know what you are losing, especially when you are a business owner. As a business owner, you have so much room for tax saving, and we just overlook. Okay, I hope I answered the question.
Yeah, okay.
Thank you so much.
Yeah,
Yes, you have answered that question. In fact, I would say that for every small business owner, for example, myself, I have my 7-year-old, and she does help me in my business. She helps me with inventory. She helps me with packaging. So it's really an eye-opener now that we can actually pay a child that is assisting income, because they're actually really doing their part in contributing to the business. And a lot of small business owners really have their spouses and family and friends really helping out in the business, and we overlook that. We overlook all those the inputs that they put into the business. We just target like family helping out. The fact that we can now introduce it into our taxes is a really helpful tool. So thank you so much, Russell, for answering that question. So I'm going to throw it out. Any other questions? Do we have any questions? I'm looking at the chat box. I'm not seeing any questions right now. So while we're waiting, I have a couple of questions that I put down. So I'm just going to go ahead and fish them out. So 1 second. All right, so you were talking about the type of deductions that we can do. And you talked about our rent. So I want to ask, for those of us that run home-based businesses and we own our property or we're renting our property, how do we calculate the deductions? If you have for someone that has a home office or they're running their businesses out of their house, so how do they go about adding that expense to when they're filing their taxes?
Yeah, okay. Thank you so much for that question. The first thing we need to know is that, whenever you are running your business, you actually have to be running your business from home, or you have to not having a separate location for your business, right? And also conducting any business activity in your house. Now, once you do that, it's now up to you to know what percentage of your house in terms of superficie, in terms of the square foot you use. If you use one of the home or use all the homes, sometimes you stay in the living room, sometimes maybe you have an home office in your house. If you have an office or one office and then your house has, let's say, 4 homes, then 1 out of the 4, that is 1/4 of every house's expenses is going to be allocated to your business. So it depends on how much of your house do you use for business. Some people will take 50% of their house as a business expense. Some people will take three quarters as a business expense. Some people will take 1/4 as a business. It depends on if you consult, I will ask you, okay, what do you normally do? Some people you just go home to only for for the recap of the day if you are Uber driver. And some Uber driver have a business incorporated. That means I just told you that you have to incorporate a business. That means they are driving Uber as an employee of the Uber business. They don't have a separate location for business office. That means their home is also the business office. Now, what do they do there? Every day when they go back, you have to calculate how much. I told you to record everything so that you don't forget. Did I eat? Did I put gas? Did I do this? What did I do? Did I go to the repair? Did I have a flat tire? He records all of those in the computer in his house. If that is what he does, he can estimate that I use a percentage of my house for business. Once you establish that, every single cost of your house, you can take that percentage as a business expense. You could actually account for electricity because you are using your light. You can account for internet because you're using the home internet for it. You are paying rent for it. So all of those are becoming business expense, basically. Yeah.
Well, thank you so much for answering that question. So at least we know now that we need to figure out what portions what the space that we use in our house, and we can calculate. So say, for example, I have a mortgage of $1,000 and I use 25% of my house. So is that how I go about calculating?
Yes. Then the fact that mortgage will be a business expense.
Okay.
Office
Thank you so
expense.
much. Thank you so much. All right, so I have another question on the EIN number. So a lot of individuals, they go to the IRS website and generate an EIN number when they want to start a business as a sole proprietor.
Yes.
Is it, and from your explanation just now, if we need to do payroll and pay ourselves running that business, we can't do it as a sole proprietor. So we need to go register a company, or we can still take that deduction for payroll as a sole proprietor.
You can take deduction for payroll, but there is so many. You don't have that more room of taking the deduction because let me see. You are not a business. You can do that to hire other people, but you cannot do that to hire yourself. Okay, who is hiring you? You are not incorporated. You are just you. A sole pro is just a person that is doing business, right? If you are registering your business as an LLC, now the LLC is paying you basically. And the main point of using an LLC is also because it's protect you against your company. Okay, you could be not just with the EIN, you hire somebody, but when it comes to hire yourself or maybe your family member, it could be unclear. Okay, they can easily see that you are just trying to to shift money or to avoid to pay taxes. But if it's a business paying somebody, it's good. It doesn't cost a lot. It doesn't cost money. It doesn't cost that. You don't have to pay something every year, every month to incorporate. You just incorporate your business within the state where you are. Now start putting yourself on the payroll, pay yourself, pay your children, pay your wife, pay your daughter, pay your mom, to actually work for you and take part of the deduction. Because if you don't do that, the net profit that you have will having less any amount that you have paid your significant other as your employee. Yeah. You are mute.
Thank you so much for answering that question. We need to tell Zoom to do something about this when someone else is not speaking and you have so much static on the background. All right, thank you, Russell. So do we have any other question? So training out to our guests, Mr. Alfred, Samuel, Christine, Valentina.
Now, okay, let's go. Maybe we can go to the PPP area and super people will have questions. So
All right.
I'm going to go very quick on the next part of this live to what disabled participant from share screen. You have disabled participant from sharing screen. I'm not able to share the screen from now from the other device where there is no picture.
All right, so I'll put that back on. All right, go ahead, Russell.
Okay. No, the one that says Russell. Not the one that says Ross.
Oh, okay.
Russell.
All right.
Okay, yeah, I can see.
Okay,
yeah. So I just want to talk about the PPP and the ELD a little bit, just as a reminder, is that a lot of people are missing, and I said that on the webinar, are missing on the opportunity on the PPP and the ELD, whereas this is the best opportunity. Why? Because everything that you can claim, you can actually put them in your taxes. Because a lot of people were eligible, even eligible for PPP and ELD, but they lost the money because they were claiming what they really did. They have done for real. Like they ask you, how much income did you make a year? You say you make, you hear that when you claim more, you have more income. You say you make, I don't know, $100,000 as a gross, which is actually what you made in your repair shop or whatever business you have. Now, when they want you to send your document, they see that you have $40,000 on it. You're losing money. When you were asking the question, you were talking about what you really did, and you were approved for maybe $50,000 because of the $100,000 that you claimed, but your taxes was already done. And now, when you were applying, you were saying you were putting real numbers. Yeah, you are recording your real income on it. Now you were losing, whether they were reducing your eligible amount or they were actually canceling, because there's what is called inconsistency between what you put in the application and what your document are actually saying. So now, if you claim that is $100,000 as a gross income, you know that, and you are approved for it. You can now, after you have done that, when you file your taxes, to actually claim the same $100,000 in your taxes. Now, if you have this tool that I've been sharing with a lot of people, that helps you to track all of your expenses. Now you are eligible to take a lot of them. This tool that I've been using, okay? This tool right here that I've been using, it actually helps people to do what? To track the income and to track the expenses. Look, over here, I use this tool to say, listen, try to remember how much income you made during the year. No, January, February, March. I use this portion, which is called recap expense. If I ask you, how much did you spend on gas? You don't know. But if I ask you, can you have an estimate of how much you spend on gas monthly? It's easier to remember. If I ask you, how much did you pay to people helping you? Hopefully, sometimes you just come up with the numbers. But if I say, okay, do you remember how much you pay on January? If you start coming with how much you pay in January, you come up with how much you pay in February, somebody helping you, how much you pay in March, and so on. At the end, you find yourself having a more accurate expenses, and you have more expense. Anytime I have done this with people, they come up with sometimes even higher expenses than their own income. What does this mean? It means that if you have claimed $100,000 as a gross, you were scared that, oh, I'm going to pay, $100,000 taxes. And I'm telling them, your gross sales is not what you pay on taxes. Now I help you to come up with expenses. Okay, when I try to help them with this simple spreadsheet, at the end, they find themselves close to, I don't know, $85,000 or $95,000 expenses. That is only $5,000 net income. So they get approved for $100,000, which is a basis to get the PPP, the EIDL, but they are only paying taxes on actually $5,000. So yes, it comes back to recording. If they have recorded everything, they will write all the information. But since they didn't do it, I came up with this to say, listen, and not only this is actually what is going to go into your taxes. This we use this for what? For two purposes. First, to track every single expense, every single item of the expense that you made for your own business or self-employment activity. Now, we use this to create your financial statement, income statement that actually matches your income with your expenses. It also shows your net income for each activity. And we know that the second round of PPP and the EIDL, the new EIDL, you have to have incurred at least 25% for the PPP to even be eligible for the new round. So this, because it's monthly, we are able to track quarterly to compare quarter one to quarter two, right? And compare quarter one to any quarter in the year to actually come up or demonstrate that there has been a loss. Since when it's established that there has been a loss, then you are legally eligible now to take the money. Not only take the money, but you can take a lot of expenses here, because this person here, for example, the gross income here, the expenses here is 49,000. What was the no income? The income is only 67. At this moment, this person told that he's going to pay income on $67,000 because he's gonna get eligible based on $67,000. But no, he's not going to be paying taxes on $67,000. He's going to be paying taxes on only $67,000 minus this $49,000, which is a lot less taxes that he's going to pay. And he has all the evidence of what he's claiming on his taxes. Okay, so that's the point where I say it's really important when it comes to this different program. It comes down to be able to come down with what information, what expense you have made, you have spent money on during the year. Okay, so is there any question on this smart topic that I just explained?
I have a question.
Yeah.
So one of the questions from the part one that we did, one of the questions I got after the seminar, the webinar was finished, was the individual that contacted me said that she had made about 50,000 on her, so she has a company already set, an LLC set up, and she filed using the Schedule C, and her income there was $10,000. But her income from her employment was $50,000. So the Schedule C was also imputed into her taxes. Now, in 2019, she did not do any business at all because of COVID. So she wanted to know, how does that play? Does she have enough income from her taxes for 2019 to be able to qualify for either the PPP or the EIDL?
So you say that how much is she? That's the
So total from her employment,
yes,
was 50,000. Then
yes,
from her side hustle, $10,000 in 2019.
2019. Yes. Over here, you are eligible. You are eligible for EIDL and PPP regardless to the amount that you made on your activity. The only condition is that you can say that your business was actually in operation before COVID. If your business was in operation before COVID, out of the $10,000 gross income from Schedule C, right? Because it doesn't count the expenses, right? That means out of, people are only seeing looking at the gross sales. So if she made sales for $10,000 as a self-employer, now the $10,000 is going to be the basis for eligibility for PPP, for EIDL. If she can show that she was in operation before February 15, before February 15, I don't remember very well. I'm still talking about those stuff. By the way, it's February 15 because COVID was starting by February and we stopped in March. So if she was in operation before February 15, then yes, 10,000 will be the basis to figure out how much income you should be eligible for when it comes to PPP. When it comes to EIDL, now for the PPP, they use the net profit. The net profit is this $10,000 minus whatever expense she's going to come up with. If she comes up with, let's say, $6,000 expenses, right? Then the net from the self-employment will be $4,000. She will be eligible for an amount that is based on the $4,000. Yes. I don't know if it answered the question.
Yes, yes.
Yeah.
Yes, thank you so much. So basically, for the business that she runs, the $10,000 is what is going to be used. So is she going to be applying for the PPP or the EIDL?
Both. Those are two different programs. The eligibility is also different. The EIDL focuses on your gross sales. They call it cost of goods and gross profit. But the gross profit is basically your net sales, your sales minus cost of goods sold. If you don't have a business that has a cost of goods sold, then it's basically your gross sales, right? So your gross sales will go to be used as the base to figure out how much you're eligible for EIDL. Now, when it comes to PPP, they're going to figure out what is the net income. So the net income is that 10,000 minus whatever expense she wants to take. If she doesn't want to take no expense, then they're going to also consider the same 10,000 as a basis to figure out what is called average monthly payroll. The average monthly payroll, once we get that, we give her 2.5% of it. 2.5 of it, basically. You time it by 2.5 when you get the average monthly payroll. Yeah, so she's eligible for both of them. It just depends on how much it will be, but she's eligible as long as she was in business before February 15. I see Samuel has a question.
Yes. Go ahead, Mr. Samuel.
Yeah, good evening, all.
Good evening, Sam.
Yeah, my question is, when we're declaring, at the end of the year, you're trying to make your tax, and you are declaring whatever income you made. I overheard from someone, and I want a clarification, and that's what I'm asking, that if you declare losses in trying to buy a house, you might not be approved. So, and all this say this PIP IDL, I hope it doesn't affect or deny one of getting approved of all this. So that's my question.
Okay, so you want to know if
yes, taking all this EIDL, PIP, and PPP, and at the end, probably you you do your business, and you're not declaring a loss, that it doesn't get you approved in trying to get a house. Because by the time you put all these people, your siblings, everybody trying to help in your business, like an Uber person, or you have to do the air freshener, the wash, everything, you put it in. By the time you do everything, you might be running at a loss. So does one still stand a chance of getting approved when it comes to, like, you want to buy houses? Because at that point, probably one is declaring loss. So that's my point. So what do we do on that basis?
Okay, yeah, thank you for the question. Yeah, I have met I met with a lot of business owners who were facing the same dilemma. Okay, yes. If you even take the PPP and EIDL out of the picture, you take the PPP out of the picture, then I'm gonna bring them back. If you want to buy your house, you are self-employed. The income that they will consider is your net income, because that is actually your residual income. That is the money that actually goes to you. That's how they see it. And it's obvious, because if you make $100,000 and you have $80,000 expense, it means you didn't have the $100,000. You have 100,000 minus 80. That means the normal income is 20. That is what they will consider. That's why you have to have a goal in mind. When you file your taxes, what is the goal? Is the goal to pay less taxes or get more refund, or is it goal to show that you want to buy a house, for example? You have to have a goal in mind. And I have a lot of people who try and they will say, oh, you don't have enough income, even though you make $100,000, $200,000. I mean, income, unless you go, maybe you just overstated your expenses and you really have those cash. Then unless you use the cash that you put, whatever you think you put, bring those cash and purchase your house, put, I don't know, 25% or 30% down, you'll be eligible. But if you expect to have an FHA loan and stuff, no, you won't be eligible because you don't have enough money to even pay that 3% that they're gonna give you. The thing you cannot pay it back, basically. So you have to have your goal in mind. Yes, if your income, because you claim losses, even though it's not a loss, it could still be, a profit, a positive net income. But the positive net income is so low for you to be eligible. So you have to know, that's why you have to consult. You should not be purchasing a house without consulting a CPA in advance. That is the mistake that a lot of people will be making. You consult with the CPA, and then your lender will advise you in how to keep your credit, in the same level, do not bring it down. But consult with your CPA tax-wise. Yes, your question is, if you have a net loss, you have less chances to buy unless you're gonna purchase cash. Now, the PPP just goes, PPP or EIDL, if you are bringing it back in, they give you money according to what you claim. If you claim that you make a profit of $10,000 when you apply for PPP, they're going to use that $10,000 to figure out how much you're eligible for. When it comes to EIDL, remember, those are two different programs. For the EIDL, if you claim that you are making $100,000 gross sales, they're going to use the $100,000 gross sales as a basis to see how much you are eligible. Okay, so PPP doesn't really have that effect. The loss I'm talking about to be eligible is the loss during the year, from one quarter to another quarter. You can make a profit at the end of the year, but you still have a loss between one quarter to another quarter. Okay, you can make you can get $20,000 from the first quarter, but the second quarter you only made $5,000 because of the COVID. That is a loss of if you want $20,000 the first quarter and you made $5,000, that is $15,000 shift loss. And you can attribute that to the COVID, and then you are eligible to get those funding. That is what we call loss. You have to demonstrate you have been incurring loss. It doesn't have to be a total loss for the whole year. It could be the loss within quarter or within for the PPP any 8-week period that you can compare. You can compare that with the period before COVID, and you can compare that with the same period in 2019 when your business was really doing well. So I hope that helps. That answers your question, Sam.
Yeah, thank you so much.
No problem.
Thank you so much, Mr. Samuel. Do we have any other questions? I have one question here. If you have any questions, please just indicate by raising your hand. So this is for a business that started in 2020. So this lady says she started the business in 2020. She has a lot of inventory. It's a clothing business. She has a lot of inventory on ground. Due to COVID, she has not been able to, excuse me. Due to COVID, she still has that inventory now, over $30,000 worth of inventory. Can she file for PPP or EIDL?
Yes, we need to know that the PPP and EIDL doesn't give you money according to how much money you have lost because of the COVID, how much inventory you have. The inventory could be the basis of the loss in your activity during the period, not even during the whole year. I told you, you can even make a profit, even more profit than you previous. I mean, I saw a lot of even self-employed making more profit because after the COVID, now they make even more profit, more sales. But they're eligible to apply for the PPP because there's a quarter or a period during the year when they can show that they have incurred losses during that period. Now, she has $20,000 inventory. What she needs to do, she has to provide income and provide the expenses. What the PPP is based on the net income. The lower your net income, the lower will be your eligibility. those loss of inventory or the inventory gets stuck there can just help to show that she didn't make sales during that period, and it makes her eligible. For example, if you see this one, for example, we will see that at the beginning, January, she made a lot of sales. Maybe COVID started on March, April, May, she has no sales at all. All the inventory is stuck there. That is the sales over, that's the loss over here, right? Even though she make the whole thing here, she sells all of the inventory for the rest of the year, and she even purchase more inventory and sells them, she will be making more profit than the previous year. But she's still eligible for the PPP. Why? Because she can demonstrate that over here she incurred a loss, right? Yes, it's just a matter of, they don't give you, people are saying, oh, I lost my car, I lost this, I need a lot of money. No, you receive the money based on the net profit. If your net profit is low, you will receive the money based on net profit. For PPP. For ELDL, you will receive the money based on the gross sales that you make. Over here, it was 60 something. I removed this over here. She didn't make sales. That means she's not 47. That means the money she receives, it will be based on 47. Let's say they give you 50% of it. Of course, it's lower than the 50% of this $67,000, right? Yeah, it makes her be eligible because she can demonstrate that she has made no sales or she has incurred losses for that period or for many periods. But it's based on gross income for PPP, for ELDL, and gross and net income for PPP. Yes.
Right. Thank you so much, Russell. I see that we don't have any questions, but I'm sure a lot of people are going to go back and review this video, and there'll be more follow-up questions. Russell,
So,
go ahead.
Basically, the only thing I want to share with you is with the taxes. A lot of people have been contacting us to say, okay, so how do you do? I know Samuel have a question. Samuel, when I finish, you're gonna ask your question. Yeah, how do we do to actually prepare or file the taxes? Yeah, with this COVID, any serious company should be able to develop on how to adapt with the situation. I mean, to be able to work virtually, basically. We see even the church working virtually. We see all the team being virtual. We see some hair salon being working virtual to show how they do the pay to assist it. So yeah, we have developed this new platform that we use to actually onboard new customer, and we call it onboardable. As we call it onboardable, as you can see. So I'm going to share the screen with you to show the people who don't have or who may need assistance, you know, from the comfort of their house, to be able to onboard with our tax practice for assistance or for any even appointment that they may have. So I'm going to share another screen that I have here, my second screen, which is, let me stop this screen right here and share the other screen. I don't know if you allow me to share. Yes, I think it allows me to share. So yes, you may have seen that at the beginning. So over here, this is the new platform that we have developed this year to actually help to all our people that are all over not the world, but the US, to actually reach out to us and share with us with the document that they have that they want us to assist them with. Okay, it's just a simple link. Once you click on it, it helps you to actually create your profile. If I go to my Facebook page, you will see on my Facebook page, you will see that I posted it over here. This is basically what you have, okay? When I share the link with you, over here, you just put your name in, and then you create your account. Once you do that, all the information that you provide over there, we'll have it in our system. And we can now talk to you to say, oh, I see that you have provided all of the information. The only thing missing here is your W-2. If you want us to review your W-2, or it's your 2019, because sometimes it's better to review your 2019. I see the 2019 taxes is there. Once you receive that, we will now just tell you how we can help you. Yeah, this is the new platform that we have developed. And the link here, this link right here that I'm going to share on the spot, link to this link to onboard yourself. I'm going to share this link right here. If somebody will be interested on contacting us for any assistance, yeah, you need to onboard yourself, because once you do that, we have all of your information in our database. We can now say, oh, for this one, can you share with me with this information? And once you do that, the person assigned to your case can better understand your own situation. The reason is because in the platform, we have so many workers working on it. Once you onboard yourself like this, we can now assign, if it's not the tax professional X or Y and or Z or A or B, we assign every person to the person who is actually taking care of you, and we can track all the activity whenever we are working on your case. So yes, you can do it from the comfort of your house. You don't even need to download. You have two platforms where when it's difficult to navigate here, we will share with another app that you can actually download it and do it from the comfort of your app. And every information that is here, we share with you, and we also share even the signed document, all the people that are on board here. And we can also even share document for you if you want you to sign any supporting document that we want you to over here. Once we send it to you, we can add this for signature. That means everything that we have, you say, see this person uploaded a document, supporting document here. If you want her to sign any legal document, we will put it here and she can actually sign it. Once she signs it, it comes back to us. So we have invested a lot on being able to work remotely with all our partner or customer around the 50 states. Yes, I think Samuel has a question.
Mr. Samuel, can you unmute yourself?
Yes. Sorry, my question is about the PPP.
Yes.
Since they're giving a second round, what is the eligibility? Do you have to file your tax first before you can get approved, or what do you need to do? And on the first one, that one has did. Since one has not get all his documents in place to make it a forgiving loan, so what are the bases for one to be able to go ahead and make one eligible for the second one? And hope it doesn't stop one from the EDIL stuff too. So that's my question.
Okay, so basically the requirement for the second PPP is that you have to show, I just say demonstrate that you have been incurring losses. And I'm going to share this other screen here. This other screen where I was showing how somebody can, if over here, let's say you have this scenario right here. If any area on any period here for PPP, you need to show that from one quarter, show which quarter you will have that have made you incur losses. Loss is also loss of income. That means you have a less sales during that period. Compare either from the first period before the COVID, if you are a new company, or compared to the same quarter on the previous year. That's the basis to receive. If you cannot demonstrate that and you are still able to receive the money, that is a fraud. So you guys have to know that. That's the reason why some people will get denied, or even if you don't get denied, you receive the PPP. Remember, the PPP is forgivable. When it comes to do the forgiveness, you will have to show those elements. You have to show in the financial statement, in an income statement, that demonstrates that you have incurred losses. That's why the first stage to actually apply for PPP for all of our customers is to create an income statement for them. This is the information we collect from any taxpayer, any business owner. We collect your income, we collect expense. Out of it now, we come up with what is called, I can actually show you over here, with what is called income statement. Okay, we come up with income statement. The income statement is what actually show, for example, this is an example of income statement that we have to come up with. Okay, this income statement, for example, is a simple one. It shows your income and your expenses, right? And over here, it compares Q1, Q2, Q3, Q4. It compares one Q against the other Q. It compares 1 year, 2020 against 2019, right? This is actually how over here you can see here. You can see that there's a 39% here, right? Then you're eligible. So if you don't even know, just go and apply. And the bank doesn't want to, you don't, by the way, when you apply, they will ask you what is the reference period. If it's a second round, your reference period, what period are you using to show that you have incurred the loss? And some people, not knowing what it means, they're just gonna click anywhere, and then it goes, whether it goes or it doesn't go, right? And then maybe they get the money. And then if they realize that you don't have the document to sustain what you're providing, either it's a fraud, this is the worst case, or you will just pay the money back, because the PPP is, to me, I see it as a grant, because once you receive it and they tell you to use it, they have a ton of way you can use it for electricity, for grant, to pay for PPP equipment, for everything that you want to spend the money on when it comes to your business. Once you use the money on that, you don't pay it back. So worst case scenario, they say you got the money fraudulently, then it's a fine. Best case scenario, they say you cannot get it forgivable, right? So that's basically how you have to see it. So you have to know that all the information, the basis to be eligible for PPP is to have to show that you have incurred losses. Same thing for ELDL advanced grants. The ELDL advanced grant is the $10,000. Remember that. You apply the first time, ELDL, you receive the money. Now you want to apply for the second time to get the 10,000 grants. You have to show that you have incurred 30% loss within any 8 weeks period on 2020. So those are the basis. And even some tax professionals don't understand this. Like, I'm explaining this to when I go to those our tax professional CPA and stuff. I'm explaining to them. So some of them don't even understand. So I'm pretty sure a normal taxpayer don't understand either. So everybody goes there, apply, whether they receive or they don't receive it. But if it's established that you receive money that you didn't have the basis, you could be in trouble. So the simple answer is that it's better to create your income statement that shows that. You don't have to file your taxes before, as long as you have this. Why? Because this information are going to be in your taxes. When you file your taxes, what I call net income, this will be your net income right here, basically, because this is the total expense income, right? Over here is total income here. Now, all of these are just to come up to the net income for the year. So your Schedule C is going to have this amount right here. So you don't have to file your taxes. Okay, if you file a tax, you put any numbers in there. Now, when we come to figure out if you can show that you have demonstrated losses, it doesn't match, then you will not be able to apply. Even though people will still apply, you might not be eligible to apply. So the best way is to know if there's any quarter, you can show any quarter you have lost income. Yes, especially if you're taking the money for the second time. Okay, I hope this answers your question, Samuel.
Yes, thank you very much.
You're welcome, sir.
All right, so I'll ask one last question before we end today's session. If someone has not filed their 2020 taxes, can they file for either the PPP or EIDL?
You can file, even though you have not filed taxes, you can still file those documents. But for you will use the 2019 for PPP if you factor anti-tax, because one of the documents is the Schedule C. Okay, the Schedule C, you will use that Schedule C of 2019 to file your PPP, right? Given that you have a net income that is higher than the projected net income for 2020, because again, the PPP is based on the net income. So if you are net, if you have all of this number right here, and you see your net income will be, for example, over here, this net income on the taxes will be $20,000. If your net income on the Schedule C for 2019 was, let's say, $25,000, it's better to use the Schedule C for 2019 because it has higher net income. But if on net income on 2019, the Schedule C, the net income on the Schedule C for 2019 was only, let's say, for 10,000. Now, when you do all your projected income, or not even the recap, this is basically the recap. You are recapping your income and expense for 2020. And then you come up with your income statement that is actually higher than 10,000. That is better to create your income statement, to file your 2020 taxes and use the Schedule C of 2020 to file the taxes. Or you can actually even create your Schedule C first. Yes, the tax software can create your Schedule C for 2020. You use it as a supporting document when you file for your PPP. Okay, I hope this helped.
Yes, thank you so much. I know I said it was the last question, but another question just came in as a text message. For nonprofits that do not file taxes, can they apply for PPP or EIDL?
Yeah, they can still apply for PPP and EIDL as long as they have some number. Non-profit doesn't mean that you're not a business. Non-profit is a company, just doesn't pay taxes, but they can have income. They can also have expenses. So if you have some type of income and some type of expenses, the difference is a net income. It could be the basis for you to apply. If you have some type of sales within your company, yes, the sales is going to be, the base for the PPP, for the EIDL. You see that you can still be eligible for PPP and be eligible for EIDL. The not-for-profit are actually included. Yes, even though you didn't file taxes, like I said, it applies to you. You didn't file taxes. Can you come up with your net income? Over here, you have net income right here. This is basically your net income right here. This amount here is your net income. That's net income right here. They will ask you, what is your net income? For PPP, they will ask you, what is your gross? Your gross will be this amount right here on your income statement. Okay, your cost of goods sold, this company doesn't have cost of goods sold because it's zero. They don't purchase nothing. There's nothing that is purchased. They don't purchase to resell. That means the cost of goods sold is zero. The gross profit is the same amount right here, gross profit. This is actually the amount that they use. But most of the time, the cost of goods is zero. So this amount is also the same amount. That's the reason why I keep saying that the sales is the base for you to be approved for PPP. If you are 67,000 right here, of course, your PPP will be higher than somebody who has a $40,000, gross sales. Okay, yeah.
All right. Thank you so much, Russell. Russell, if you can please drop your screen share.
Yes.
Around them. Okay. So Russell, thank you again so much for doing the part 2 of this webinar on tax planning for entrepreneurs. We appreciate you so much, and this is a blessing to our community. We'll keep resharing these webinars so that we can educate people that are planning to start businesses or the people that have already started. I mean, the 3 mistakes that you talked about today, I'm almost positive every small business owner is guilty of that. You do a business launching or you do a showing and you forget to record the launch that you offered the new clients that you don't even have. That's a business expense right there. So yes, we've learned a lot today. And from this class, we already see that there's a part 3 coming up because there are more things that you need to expatiate on. I'm sure everyone will be interested to know what type of deductions we need to make as small business owners, so we're not leaving anything out. And hopefully at the next or the 3rd session of this webinar, you will be able to share with us a screen. Do a better screen share, Russell, so we can see the figures, impute the figures so that we can learn better. We want to say a big thank you. Like I said before, we do appreciate you. It's all very refreshing to have one of our own in our community teaching us. So you're speaking our language, you know, so we appreciate that. So for everyone that's come on today, I want to say thank you for listening in. I know we've gained great value from everything Russell has taught today. And Russell will have to contact you again to schedule another Zoom meeting so we can do a part 3 of this. We appreciate you. We want to say thank you again. All right, so I'd like to close out today. We want to say for our community, learning is essential. Owning a business is essential. We cannot leave that out. It's good to be employed, but as we're growing as a community, it's essential that we begin to look into starting new businesses. So if you're thinking about starting a business, you know, watch this tax planning webinar, and you would see that it's very beneficial when you own your own business. So thank you, everyone, and have a great evening. You can unmute yourself and say bye. All right, thank you, everyone.
I'm sharing with you the last clip.